Good morning, everyone. Welcome to the DTN Ag Summit series. I'm DTN Farm Business Editor Katie Dehlinger. I will be your host today, just like I was for the DTN Ag Summit. Now, this is our first of these events. We're going to be doing them quarterly, taking a little bit of our Ag Summit flair, everything you're used to in agriculture's premier business event, and bringing that information, that content to you more frequently at the times of year when you need it most. So today we're going to focus on all the business information you need to get set for spring. We're going to talk about the fuel markets, particularly diesel. I know that this is entering into a heavy use season for our farmers and ranchers. This is the time you got to fuel up all that equipment, be ready to go. We've got DTN Refined Fuels Analyst Brian Milne on tap to help walk us through what you need to know in those markets. Then we're going to flow on and we're going to visit with Jung from Mosaic. He's going to talk about fertilizer availability, a little bit about prices going forward, because I know a lot of you have probably locked that in already. Major arrangements know what price that's going to be. And then after that, we're going to get into the real meat of our event today. We're going to talk about the spring weather outlook with GTN's John Baranick. He'll show a bit about those long-range forecasts, what you can expect for your planting window as the season gets forward. And then Todd Hultman will join us and we'll talk about some of the grain marketing opportunities that are out there for you, what to expect out of those markets. But before we get into all of our content today, I want to just make a couple housekeeping notes about the Whova platform. If you have any questions, just on the right-hand side of this screen, you want to click on that Q&A and enter those questions there, and I will make sure to ask our guests those questions for you. So enter them anytime during the presentation and I will ask those. You can also answer a couple of the poll questions we have available in that poll tab. You can chat with under attendees or go into that discussion board and look at some of the posts and have conversations on the topics there, all without navigating away from the page. We don't have any breaks planned for this morning, but depending on the time and the schedule, we may take a few minutes here and there just to help us get the broadcast go smoothly, keep everything flowing. So if you do need to get up, feel free to do that. The presentations and the shows will be available in this Whova app, in this platform for 30 days after our event. So if you miss something, you can always go back and watch it. And we should have those up for you by tomorrow. So just be prepared for that. And I think that's all of my housekeeping to get things started. So I want to go ahead and bring on our first guest, Brian Milne. Brian is DTN's Refined Fuel. Yeah, well, glad to have you here, Brian.
There you go. I can hear you now. Okay, perfect. Well, no, thank you. Yeah, it's certainly a very interesting time. I can tell our audience that we certainly have an improved outlook for diesel buyers compared with a year ago. But of course, a year ago, there was a lot of worry. This would be days after the Russian invasion of Ukraine. So we still are dealing with a lot of that fallout. But we did see diesel futures. It's the ULSD futures contract, HO symbol for those who are playing at home. It did fall to a 13-month low last week. We're almost 20 cents from that low last week, but still it is lower. We do have a contract expiration this afternoon, so that could be affecting some of the move today. But the low, we reached that low on an improved supply-demand disposition. The balance is improved. I'm not sure if we have any charts. If we can,
we can bring those up for you.
Yeah, if we could put the first one up, it'd be great. Take a look at that so you get a visual on this. But what we're going to see is that distillate inventory, and distillates include both heating oil and diesel fuel. It's mostly diesel fuel, and the specs are pretty similar at this point. But what we've seen is that distillate fuel inventory moved above the year-ago stock level for the first time in February. Okay, so that we were trailing that number for quite a while, and we finally moved above it. Stocks do, though, remain well below the historical level in the United States and globally. So there is still concern over the oversupplies. This is not going away. And what we've seen since really late last year is a gradual rebuilding of distillate stocks, but that has come because of lower demand. Demand has been reduced largely because of a global slowdown in manufacturing and also less freight movement. That's both on the high seas and on U.S. roads. U.S. manufacturing activity has fallen for 3 consecutive months. In fact, manufacturing is in a recession in this country. In fact, if we look just yesterday on Monday, the Dallas Federal Reserve Bank said manufacturing activity in Texas in February fell to its lowest point since May 2020. And that's when the country was in COVID lockdown, if we recall. So why do I bring up manufacturing in line with diesel? Diesel is a workhorse fuel. I'm sure the audience knows this, using it in that manner. But in the United States, especially, it's used in construction and industrial settings. The recession in manufacturing that we've seen has loosened up the ability for refiners to start rebuilding some distillate supply. Also, with the slowdown in manufacturing, also means you're moving less goods. That means less trucking activity. We went from having a very scarce, limited truck drivers and trucks to really now having overcapacity. So this is what we've seen so far. U.S. diesel demand has been weak in early 2023. In fact, for the first quarter, we're still two-thirds through that right now, but it's expected that diesel demand this quarter will be down 4% compared with the first quarter a year ago. However, expectations do call for diesel demand the second quarter to be on par with the year ago. So there is expectation that diesel demand is going to pick up in the next couple of months. And then again, it is seen again trailing off in the second half of the year. So we do see that, but right now we have a lower price environment, a little bit more supply. So it does seem like we might find ourselves in a little bit of a buying opportunity here before diesel prices start picking up again, which is what I do expect later in the second quarter. I would also add to that we are seeing more production for diesel. U.S. refiners have been tilting their yields to produce more diesel. These are incremental gains at best because it's challenging. You just can't simply make big moves and changing from making different fuels. Gasoline is still the primary output of refiners, but with higher, they call them crack spreads. These are your profit margins for refiners. They certainly had a lot of incentive to move to make more diesel, and this trend is going to continue. It's gradual, though. But that's probably the best news I can put up here for diesel buyers. Like we see this window, I think it's a shrinking window. A lot will be told later in the year, depending on how the economy is doing. If we do find ourselves falling into a recession or things really contracting, we could see diesel demand really come off hard on that. I'm not anticipating that happening too much. I do think we might see some weakness going forward, but I don't think we're going to see a big contraction in diesel demand. And then when we're also looking at this trend of increased diesel production by refiners, this is coming up against a tighter refining capacity. There has been certainly policy to reduce how much oil we consume in the United States. This has affected some long-term thinking by people in the industry, and especially during COVID when we had those slowdowns. The United States lost almost 1 million barrels per day of refining capacity. So that means it takes a lot more. When you have a lot of demand, it limits your supply rebuilding, which is what we saw for all of 2022. Now, we did see there was one expansion that came on just came online in January. ExxonMobil added 250,000 barrels per day of capacity at their Beaumont refinery. So that gives us a little more wiggle room. But then I would note by the end of the year, a refiner in Houston will shut down permanently, and that's going to pretty much erase that gain. That refinery has a capacity of about 250,000 barrels per day, and they are adamant about shutting down that refinery. So going forward, we are looking for a tighter refining capacity, and that's going to continue in the United States, especially as some refiners also retool to make more renewable diesel. And let's see, when taking a look now and looking kind of at this balance, another dynamic we could look at is when you look at your forward calendar spreads in the ULSD contract. What we would notice in doing so is looking at, even before Putin's invasion of Ukraine last February, we already saw the backwardation in the diesel forward market structure, widening. And it was reflecting the strong demand that we were starting to see from the end of the lockdowns into early 2022. Then following the invasion and a lot of worry about supply, Russia right before the invasion was the largest energy exporter in the world. And certainly they produce a lot of oil and ship a lot of oil, a lot of diesel fuel to markets. We saw that 6-month calendar spread, reached a record high in April. And then we saw it again spike, but not quite to that level in the fourth quarter as East Coast distillate supply plunged. So we did see that. We came off a bit mainly because of China's zero COVID policy. The demand was slashed. China is certainly a massive consumer of energy. That slowdown helped allow some of the rebuilding of supply, taking off a little bit of demand from the market. And that helped pressure prices and find a slightly more balance in the global supply demand picture. And we're seeing that now that the 6-month spread has come off pretty sharply from these highs, still well above normal, for this for what we've seen historically, but it's certainly well below what we saw last year. So this is all pointing to next few months of an opportunity for buyers. Diesel inventory in the United States is expected to end the second quarter about 5% higher than it did the end of the second quarter last year. So there is some opportunity in the short term. I would say supply risks abound though, and a resurgence in industrial activity would certainly lift demand and could cause another spike in diesel prices. But I think you have a respite, going through the spring planting season.
Interesting, Brian. I think the supply side risks, that's a little bit of a concern for farmers because that can move the market really quickly. Can you expand on that a little bit?
Yeah, absolutely. We're below, if you look at some numbers, I think we're about 10%. Let me just check this number so I give it to you correctly here. When you look at the 10-year seasonal average, people don't look at it that much, but we're right now inventory is 12% below the 10-year average. So that's telling you the supply is pretty tight. This slight rebuilding that we've seen, why it's comforting and pulling prices down a little bit, it's still worrying that if there's any sort of little bounce back in demand or any sort of mishap with a couple of refineries, having issues where they shut down, you're going to see any of those. You're going to start seeing drawdowns again in distillate supply. If you start seeing the drawdowns in distillate supply, and if demand is kind of level and not really declining but flatlining, maybe even increasing a little bit, that's going to pull down the supply, and you're going to definitely see the ULSD price go up. You're going to see the forward curve move up. We're in backwardation right now. You would expect that backwardation to simply widen, and that's going to lift prices. So we're really looking at that right now. There's been a muted reaction, and just to look globally, just to get into that just a little bit more, the G7, the group of 7 nations, along with the European Union, have put together price caps on Russian products, for instance. And what this means is that Russia, exporting their diesel, they can't go over a certain price. It has had a muted reaction. That this, by the way, took effect less than a month ago on February 5th. We haven't seen a big response to that yet, but if there are some tightness in some parts of the world, that could start amplifying global prices as well and pull on U.S. diesel supply to be exported, which would of course lift prices in the United States and dry out supply. So you're really kind of carefully watching this, and it's going to be predicated really on what happens with demand. So I hope that helps a little bit.
Now, Brian, I'm getting a lot of questions here related to something you just briefly mentioned in there, which is renewable diesel. So we've got a couple of those. One of those is, what's happened with the U.S. diesel refining capacity? Could that come back longer term? Or is that due to oil companies really putting more money into the new soy oil production we're hearing out? The other is just give us your spin on renewable diesel.
Okay, well, I appreciate those questions very much. This is especially true in the West Coast, where we've seen a few refiners over the past few years shut down part of the refinery or even the whole refinery to convert it from processing crude oil to processing vegetable oils and whatnot to make renewable diesel. They're highly incentivized to do so, not just by federal programs. Of course, we know about the renewable fuels. Let me get this wrong. We know about the. I can't believe I can't remember the name. The RFS, Renewable Fuel Standard. The name just jumped right out of my head. We know about that for an incentive, where the RIN credits are certainly worthwhile for some producers to go after. But you also have on the West Coast some other state laws, especially the low carbon fuel standard in California and along the Oregon and Washington, some other state programs that are certainly incentivizing renewable diesel. So what has happened in the short term? Why these changes are being made? You're losing diesel capacity diesel producing capacity on the West Coast. It'll be replaced to an extent with renewable diesel, but not enough. We're not talking a barrel for barrel change. In fact, you're going to be well short on the West Coast of what you were beforehand. In fact, when you look at this, we're looking at the West Coast this year becoming what are called refinery short. Now, the short mark, in other words, not having enough production to meet its demand. This is a change where you were kind of more balanced last year and earlier that. So renewable diesel is certainly having a big effect on the West. Of course, we see some other projects going on in Louisiana and other locations, but it's the West that we're really focusing on. Seeing a real big growth. It's going to keep prices elevated for a while. Expect also to see that you might be seeing some imports of renewable diesel coming from places like Singapore to the West Coast to help satisfy that demand. So, like I said, the West Coast in particular is going to be struggling. Longer term, we're moving to a new environment. We're looking at likely higher ethanol volumes, likely more electric vehicles and more renewable diesel. How that transition adjusts, I think, in some parts, especially with the renewable diesel side, is going to mean some higher pump prices. I hate to say, for some locations, I think it's eventually it'll spread, more widely. But this is going to be felt most, if I say it again, in the West Coast and the Rocky Mountain area, where we're seeing these transitions.
That kind of leads into our next question, which is, would you lock in diesel fuel needs for spring now? What are some of the things farmers should think about when they're purchasing those fuel needs for the year?
Sure. No, I certainly understand the question. I'm just going to start out by saying I'm an analyst and I'm not allowed to offer advice on your buying. That's just not, my role. But having said it, the way I am looking at it, I think a window has opened. I think it's going to be beneficial, when you look at the short term, when I'm meaning short term, like the past year and a half, what we've seen going on. This is probably one of your better times to buy. I think the risk that prices could be lower later in the year is only if we're looking at a real economic downturn. I think that's the big risk. So I do think we have a window here. I think stocks are going to, there's some rebuilding expectations on this, and I think now to the next couple of months is probably might be the best opportunity we see, barring some sort of major economic downturn later this year.
All right. Thank you very much, Brian, for joining us today for this first session of the DTN Ag Summit series, Get Set for Spring. Brian Milne, thank you for joining us.
Thank you very much, Katie. Thank you, everybody.
All right. Well, that was Brian. He is on the East Coast, works for DTN. I've interviewed him a number of times for different stories, and it's always nice to have him join us here for events like this. And so now I want to turn to the next input that's really important for farmers this time of the year. We're going to talk a little bit about fertilizer. We know that those prices over the past 2 years have really skyrocketed, and lately they've come back down. They're now a little bit less expensive than they were last year. I got a chance to visit with Andy Jung. He's the chief economist at Mosaic last week. He is traveling and unfortunately unable to be with us live, but he was able to visit with me. And so now I'm going to turn it over to our conversation with him. Well, I am here today with Andy Jung. He's Mosaic's chief economist, and here today we're going to talk a little bit about fertilizer supply, a little bit about prices, and about what farmers can expect as this growing season gets started. Andy, thank you so much for joining us for the DTN Ag Summit series. It's wonderful to have you here.
Thank you.
Thank you. Can you tell me a little bit about what you do at Mosaic and the perspective you have on these fertilizer markets?
So as Mosaic's chief economist, my job is largely to try and predict what the future is going to hold, which is rather difficult. There's many things going on in the world, and they can impact ag and fertilizer markets quite substantially. So I while away my days trying to anticipate what those things are going to be and how they're going to impact our business.
Well, and you really hit it. Things change a lot very quickly in agriculture. We saw a lot of it last year, especially in this fertilizer space. And I know what farmers are looking at today is that prices have softened a bit since the fall, really come down for a number of different products. Tell me a little bit more about what you're seeing at Mosaic as far as some of those price sides and the moves and what's driving that fertilizer market.
So if we back up to last year, probably the biggest driver, well, there's a couple of them. The big drivers were reduced supply. And on the nitrogen space, that was largely predicated upon the invasion of Ukraine by Russia and how that impacted natural gas prices in Europe in particular. On the potash side, it was the loss of an export port by a large producer in Belarus, again, somewhat related to that Russian invasion of Ukraine. And on the phosphate side, it was supply constraints from China. So China is the largest country of exports for phosphate fertilizers in the world, and they took a decision from the government to constrain those exports, and we saw them fall by nearly 50% year over year. As we fast forward to this year, a lot of those issues are still in play, but they've softened at least somewhat, particularly on the nitrogen side. We've seen gas prices in Europe calm down from the very high levels of last year. Though on the phosphate and potash side, we're still continuing to deal with those supply constraints, and we'd expect that those constraints will persist for some time to come.
Okay, so what it sounds like is nitrogen is likely to see, some softening in prices because of that natural gas situation, but the struggles in potash and phosphates will resume. What's something that could sort of change that situation for potash and phosphates, or is that a really long-term, long horizon solution or fix?
I think with phosphates and potash, it is going to be a bit more long-lived, but it's important to point out that the very high levels of pricing that we saw last year have dissipated. There was a lot of panic buying. There was a lot of uncertainty that, what does this invasion or these new government policies portend for availability of supply? And so there was a clamoring to get those supplies by a number of buyers around the world. Cooler heads have now prevailed, I think is probably the best way to put it. And while supplies are still tight, there's not as much call to panic, and as such, prices have softened. But to go back to pricing, the very low prices that persisted, say, in 2019 or 2020, that seems to be rather unlikely anytime in the near future.
Well, farmers understand that a lot of fertilizers prices is tied to sort of the corn market and what the underlying commodity can do. And I know a lot of the conversation in that corn and to some extent in the soybean space is that we've hit sort of a new plateau for prices, as far as what the break-evens for farmers will be and what they can expect from the market. Would you anticipate that fertilizer prices are going to be higher for the longer run then as well?
Generally speaking, yeah. So there is certainly a correlation between ag commodity prices, corn or beans, and fertilizer prices. And one would expect that. That's kind of textbook economics, that if the price of an underlying commodity like corn or soybeans is elevated, farmers are being incentivized around the world to maximize yield. One of the ways to do that is to apply fertilizer. So demand for fertilizer grows, and all else being equal, that means the price of those fertilizers or any input is likely to rise as well. So that is, we are very bullish on ag over the medium term. So not just this growing season, but also next year and perhaps even beyond. We look around the world at many ag commodities and we see a persistent shortage or tightness of supply relative to demand for some time to come. So I would anticipate just from that demand relationship to fertilizers that fertilizer prices will have some support for some time.
Okay, so sort of shifting into looking at this spring season, farmers are getting itchy and ready to get out in the fields. I saw some pictures that farmers are already at it in Texas. Some have already finished up getting this planting season started. I know in the fall, the Mississippi River levels were an issue for transportation. Do we see any transportation or logistical problems getting fertilizer where it needs to be this spring, or are supplies pretty adequate?
From a logistics standpoint, there's always, it seems, at least some small hiccups in the spring season, whether or not the river has too little water in it or too much water for a period of time. Rail performance can struggle as well during those peak seasonal needs. My ability to forecast the weather for this spring is a bit limited, and as such, I'll probably pass on making an attempt at that. I would note that U.S. growers are advantaged in the fact that there is a large domestic fertilizer industry. So whether it's production of nitrogen, production of phosphates, or production of potash, which happens to be just north of the border, our friends in Canada specialize in that nutrient. So there is a very large North American supply base. I think if there are concerns about availability, it mostly behooves growers or buyers to step in and have those conversations sooner rather than later. Trying to get those just in time, right before planting purchases made and get that fertilizer delivered to the farm might be challenging. It seems to always be challenging in any given year. So I would recommend people engaging at their earliest convenience.
Absolutely. I think a lot of our growers, especially after the past few years, have been a little proactive in this space. I know they probably paid a little more this year because they booked it early, but they'd much rather have it in hand when it's time to go and get started in the field. All right, Andy, so when you're looking at the agriculture space and the fertilizer markets, what stands out to you as something that farmers really should be keeping their eye on for the year ahead? Because I know we're just getting started with the 2023 planting season, but farmers are always thinking ahead and planning ahead and watching these markets. What's something you've got your eye on and that they need to know in the year ahead?
Well, if we start with ag, as I mentioned before, we're pretty bullish ag, and we think that if we look at the balance sheets, the likes of the USDA will publish for all the grains and oilseeds that they track, that it seems like there are some potential headwinds on production in certain parts of the world that could make those ledgers even tighter and therefore provide even more support for ag commodities. And if we look at Brazil today and the safrinha corn planting being delayed and the potential that could stymie their yield prospects. If we look at China, now that they're opening up after COVID, there is a potential for much better ag commodity import demand from that geography. If we look at where they were pre-COVID to where they have been during COVID, there's significant decline in import needs that could reverse. That isn't being taken into account for quite yet. Continue to watch, Russia and Ukraine. The expectations for Ukraine production here this year continue to be trimmed back, I think it's fair to say. So again, all signs point to a very constructive ag commodity environment. On the fertilizer input side, I think availability is going to be there. We talked about the North American production base. From a pricing standpoint, prices are much more moderate today than they have been, say a year ago. And as such, the return on that fertilizer investment is looking more compelling. And I think moreover, growers don't want to risk yield potential by trimming back on rates for a second season if they did indeed trim back last year, given these elevated ag commodity prices.
Andy, you made a really good point there. I have heard a few farmers tell me that it is going to be the most expensive corn crop they've ever planted this year, just with the cost of inputs, and they definitely don't want to miss out on any potential yield when it comes down to getting that crop harvested at the end. So they're going to need all the nutrients they can get. All right, thank you very much, Andy Jung from Mosaic, their chief economist, joining us today for the DTN Ag Summit series. Thank you.
Thanks, Katie. Happy to be here.
All right, that was Andy Jung from Mosaic, and we got a chance to visit last week. If you have any questions regarding fertilizer for Andy, please drop them to me either in a message in Whova. You can send it to my email at DTN, and I will send those on to him to have him try and get some answers to you. Maybe I'll also turn it into a Q&A column for everyone to read on dtnpf.com. And so we want to move on to our next topic of the day. This is one that I know everyone is very interested in. It's a top line subject for this time of year. Everyone wants to know about spring weather and what they can expect for planting. And so I want to welcome DTN ag meteorologist John Baranick to our studio again. John, welcome back.
Hey, it's great to be back in Omaha. I live up in Minnesota, and we've got all kinds of snow on the ground. It's nice to take that drive down and not see so much of it anymore.
Well, I think there are some parts of this country, especially this area, that are happy to see some of that snowfall this year to recharge that soil moisture after some of the drought in this, especially in eastern Nebraska where we are this year.
Right. We'll see just how much that's actually going to help as we go through our slides here today. So, yeah, we'll be looking at the where we've been here through the winter period. We'll take a look at the spring weather planting that's been going on here. Or not yet, but the weather for planting. We'll also just kind of breeze through the entire growing season. We'll make sure that we have a good idea of what we can expect going forward. So, with that, let's take a look right at the drought monitor. This is just updated last Thursday. Again, like we've been looking at for the last couple of years, thanks to La Nina, the western half of the country has really been in drought. We've had a lot of reduction in that, though. If we look at the last 3 months worth of it, anything in green is improvements in the drought. And you can see, especially east of the plains, we've gotten rid of a lot of it. We had some dry weather over the fall season, but over the winter time, we've done a lot better at getting a more active pattern here through the winter season. And we've definitely seen that here east of the plains. Unfortunately, that hasn't really translated to too much of the plains itself. So from the Canadian prairies all the way down to Texas, there's only been some limited areas where we've seen some improvement, and we've actually seen some degradation in that as well. Out in the west has been a very active pattern as well. So we've seen a lot of storm systems moving into California. If you remember back in January, we were talking about some issues with flooding. They've got another couple of storms here this week that have really brought them some improved precipitation. So they're sitting pretty well down there as well. But, even though we've lost a lot of the drought here east of the plains, it doesn't mean it's completely translated to soil moisture just yet. So right now we're looking at, just updated this morning, it's modeled soil moisture here, the top 100 centimeters or 40 inches of soil. And as you can see, most of the corn belt here is in red, meaning below normal soil moisture. There's some areas there in the Tennessee Valley, back through Arkansas, and then across the Southwest that have done a lot better. But for most of our areas that we're most concerned about here in the U.S. for growing, we're still limited in our soil moisture. This is modeled, and that could be just because the soils are modeled to be frozen at this time, that they're not soaking up a lot of that moisture that's come along. But for the most part here, we're pretty dry. And looking at snowpack, how can we recharge this? We're sitting, compared to normal, not too bad across Minnesota and the Dakotas, thanks to that big storm system we had last week, where a lot of folks there from Wyoming through Wisconsin saw 12 to 18 inches of snow, really built it up kind of nicely. But before that, it was basically eastern South Dakota and northwestern Minnesota that had above normal snowpack for this time of year. So we're going to be dependent on some more storm systems coming up here this spring season. Of course, today is February 28th, which means it's the last day of meteorological winter. So we're looking forward here to the spring, and we're going to be dependent on those spring storm systems to bring us our soil moisture. So going back over the winter season, just kind of briefly, temperatures there on the left, if you added up every day from December 1st through today, you would get the weather pattern there on the left, talking about temperatures, has been very warm across the eastern half of the country. We've basically had a semi-permanent ridge of high pressure across the southeast, and that's really kept them very warm. Meanwhile, we've had a pretty persistent trough out in the west. It's been producing a lot of those storm systems, and you can see across the country then we've had a pretty good precipitation there over the last 3 months, especially in California, big bullseye there, another one up in the upper Midwest, also in the lower Mississippi Valley. So, you also have to keep in mind that this is the winter season, and it's not our typical wetter time of the year. So even if we've been getting above normal precipitation in some areas like Nebraska or the Dakotas, it hasn't had a huge impact on our drought just yet. So before we get into the forecast, I know some of us here have heard me talk about this before, but for those that aren't, and just a reminder of how DTN does its forecast for the future is we really look to the past to tell us about the future. We've noticed, and it's pretty clear that weather follows patterns, and if we can find out what those patterns are from the past that look similar to where we are now, we can use how the past worked out to guide our future. So that's what we look at when we talk about analog forecasts. So for example, if 2009 is a similar year in terms of where we're going with ocean temperatures, where we're going with trends, and the jet stream and all sorts of things we look at, we can use what happened in March, April, May, June of 2009 as the basis of our forecast for March, April, May, June of 2023. So we do that. We add in computer models, which have gotten a lot better over the last decade. And our three experts down here at the bottom put all that together and massage the data. And between the three of them, I know I've mentioned this before, but they have over 80 years of forecasting experience. And so it's quite a lot of experience. And, they swear by using this analog approach. And I trust them wholeheartedly. They've been very, very accurate over the last couple of years that I've been more intimately involved with them. And so you might be thinking to yourself, okay, meteorologists can't get 2 days from now. Right. How are they going to get 6 months from now? Correct. Well, you're kind of right on that. I'm not going to be able to tell you what the high temperature is on the 4th of July or whether or not there's going to be rain obstructing your firework display. But we can understand some of the patterns that are involved over the course of a month or over the course of a season to get an idea of what the impacts might be. So here, just as an example, is the forecast we made back in December 2021 up at the top for summer of 2022. So we're looking about 6 to 9 months in the future. And we were expecting a very warm plains, western half of the country really. That's on the top left. On the top right, we're expecting a lot of dryness across most of the growing areas, and we were very concerned about what that would do to our yields for last year. And if you look at the verification at the bottom, we got the pattern actually pretty darn close there. If you look at, most of the country ended up with above normal temperatures, so we were a little off there in the southeast, but overall the pattern was pretty close there. Same with precipitation. Now the precipitation map there isn't completely granulated, so we don't see some of the flooding areas that had issues in eastern Kentucky or around the St. Louis area. But for the most part, the pattern kind of fits. So keep in mind that when we go through these forecast images here, we're going to be looking at what the patterns are going to be, not exactly the specifics that are going to be on your farm. So again, I've gone through this before. I'll just go through it briefly. What are the things that we look at? What really drives weather? What are those clues that we're looking at from the atmosphere and from the oceans to help us decide where we're going to be going in the future? The biggest one, the biggest global driver of climate is ENSO, the El Nino Southern Oscillation. We've been in La Nina conditions for a long time. I've been talking about it. You've been hearing about it. I'm sick of it. You're sick of it. We're finally going to get into a better period with that. And I'll go over that in just a second. But that's the biggest driver of weather across the globe, really, but especially here for anything that touches the Pacific Ocean, both here in North and South America. And we've got pretty good skill at actually forecasting that for about 5 or 6 months. Models are good for about that time before their accuracy starts to wane off, and we get a little curious about their spread and everything. The other big factor that really tells us about the weather is the polar vortex. We've mentioned that quite a few times. If you've been reading on DTNPF, you've been hearing me talk about it several times over the course of the winter. And that really just describes the jet stream that goes around the North Pole. When it's really strong, it keeps all the cold air locked up there near the North Pole. When it's a little bit cooler, or when it's a little bit weaker, it breaks into pieces, and that's when we get the big drops down into our part of the country. And so we've got pretty fair skill at that, about 4 or 5 weeks maybe of good forecast for that before the accuracy trails off on that. Again, everything else, which is really important, is either trends or basically how the weather's been changing over the last couple of decades. Weather has momentum to it, so things that have happened in the past kind of build upon itself going into the future. And then everything else is what we call subseasonal effects, things like soil moisture, cloud cover, thunderstorm clusters around the equator, smaller things that are very, very difficult to forecast. Like I said, I can't tell you what the temperature is going to be like on the 4th of July. That's going to have a big impact on what's going to happen later in July. So that's something that it just leads to more uncertainty in the forecast, and why we can't get too specific, and why we have to talk a little bit more general. So if ENSO is the big driver of weather, where's it going? What's going on with that? If you look at this image here, this is the climate forecast system, the American climate model. And if you trace that black line backwards in time there to the left, you can see we've been in a very steady state La Nina, and that goes back for the last 12 months. If you go back even further, we've basically been in La Nina conditions since fall of 2020. Like I said, we're sick of talking about La Nina. Thankfully, over the last couple of weeks, we've seen some temperatures warming off the coast of South America, and so we're finally getting into the more neutral conditions, or basically where temperatures should be this time of year in the Pacific Ocean. And if you look at the forecast going forward, the trend is to continue to go warmer and warmer through the spring season, eventually getting into El Nino conditions here by sometime late this summer or early this fall. And you might be wondering, what are all these lines on there? Which one do I look at? Basically, we can run this model several different times. We could run it, make a little tweak to it, run it again, make another little tweak, run it again, and that's what all those different lines are on there. If you see the black dashed line, that's the average of all of them out. And if you follow that, it crosses over into El Nino territory there in July. So we are getting rid of La Nina. That's going away, thankfully. We're getting into neutral conditions here over the next few months, and then a possible El Nino there in the summertime or possibly early fall. But, the U.S. isn't the only one that has a climate model. Basically, every developed nation across the globe does. And here's a smattering of a few of them. And they all show the same pattern. Not all the same magnitude or the same timing, but the same sort of pattern. We're getting out of La Nina through neutral conditions here during the springtime and into the summer, and then bordering on an El Nino for the summertime and the fall. So we can have pretty good confidence then with all the models really showing the same sort of idea that we're going through neutral and into El Nino, that that's going to guide our analogs. That's going to guide that we can be confident about the forecast coming from these global models. And so as long as we pick some good analogs that show the same sort of pattern, we can have good confidence in what they show. So now we can head into the spring forecast. What's it look like? Well, if you were with me in December at our Ag Summit, it doesn't look a whole lot different from what I showed you then. We're still under the influence of La Nina, and you got to be telling yourself, John, you just told me we're getting out of it. Well, unfortunately, it takes some time for the atmosphere to really respond to the changing conditions in the Pacific Ocean. So there is still a little bit of a lag period of about 6 weeks or so where we're going to be dealing with its impacts. And so this pattern here that I'm showing you for the spring season is actually very typical of what we see during La Nina. So very cool conditions across the north central U.S. into Canada, and then very warm across the south. In terms of precipitation there on the right, very wet conditions across the eastern half of the country, specifically in the Ohio Valley, and then drier kind of in the plains. Even a little, if you're out there in the Pacific Northwest, even a little bump of increased precipitation in that area. So let's break it down a little bit month by month. Oops, and it didn't come up here as a PowerPoint instead of a PDF instead. But the temperatures there that I meant to do on the upper left in March showed kind of a different a pattern here where we've got warmer temperatures in the southeast, cooler temperatures in the west, kind of basically the pattern we've been in for the last several months. And that should be what we're expecting there in March. Really what we're looking at is that ridge of high pressure really kind of keeping temperatures warm here over the next couple of weeks. But we will be losing that influence from the southeastern ridge. And once we do, the trough that's now over the west will move into the middle of the country here, probably late March, and continue through April as well. So you can see the Arctic air kind of flowing in east of the Rockies there for April in the upper right. But eventually we're going to get out of this pattern, and La Nina is going to lose its effects. We should get back to what I like to call normal. And normal means, at least east of the Rockies, normal temperatures here for May. If we look at the last frost date here that I put up there in the upper left, with the cooler conditions we're expecting in April, we're going to have some late frost, I think, there for the eastern half of the Corn Belt. Once we get into May, and that's when we see normal frost dates ending in the upper Midwest into the northern plains, we get more normal temperatures, so we may have some late frost there as well. So anybody who's thinking about planting early, we might have to keep our eyes on the weather forecast, make sure there's nothing coming up that might be a little bit concerning for that. In terms of precipitation then, March looks like it's going to be another wet month here. We've had active weather over the last several months, as I mentioned. It continues here at least through the front half of the month, and that really brings out some heavy precipitation there for the eastern half of the Corn Belt. Even parts of the plains are going to be in that as well. So, this has at least some optimism for those folks in the southwestern plains, anyone who's growing wheat or needs their forage to come up here with good vigor. I know a lot of it didn't go into the ground very well last fall, but we have at least some help here in March, and that's going to be important because if you look at April and May, we go dry again. So we don't have very good optimism after March of getting a lot of moisture in when wheat is heading or forages are starting to come up. So we may have some issues with that. In terms of planting here for corn and soybeans or any other spring wheat we have going on here in the northern plains, with the drier conditions, honestly, as long as the temperatures don't bother you too much, the precipitation probably won't either. The eastern half of the Corn Belt still might have some issues there if March is super wet and we really fill up those soils pretty good here over the next couple of weeks. We may have some issues there, especially as we go through May, but at least early crop growth looks like it's in pretty good shape for the eastern half of the Corn Belt. So just and back an overview here, La Nina is becoming a neutral, but its effects are going to linger for the next few weeks yet. We're going to get some colder bursts here for March and into April as well, so We're going to have some issues probably with some later planting than optimal. We might have to push some of those March and April plantings back to April and May, but for the most part here, not too bad, as the precipitation really shouldn't limit us too much in a lot of areas. The drought, though, is still going to remain an issue in the plains. Now, while we may have some better precipitation over the next few weeks here in March, April and May doesn't look like a good chance to really eliminate that drought. So we're still going to be having issues with that. Anybody who's got wheat or forages out there are probably going to see some issues. And then as far as frost goes, we'll probably have some late frost there in the eastern half of the Corn Belt, where typically that is sometime in April. We may have some late frost there. Back towards the north, there's kind of an average risk for a late frost this year. Now, getting towards the summer, and when we're kind of the most worried about how the crop is going to do and how we're going to get, getting it into the ground is one thing, but having it grow throughout the season is another. And what we're looking at here looks worse than it probably will be. So we're still looking at the West as being kind of above normal, Texas as well. So anybody out in Texas, I'm sorry, I don't have good news for you today. Don't shoot the messenger. But for the rest of the Corn Belt here, and for most of the plains, honestly, that look on temperatures doesn't look too hot. And most of the Corn Belt there should have normal temperatures going on. As this forecast shows, I might have some disagreements with it, and I'll share that with you in a moment. But in terms of precipitation, it also doesn't look great, especially if you're anywhere from Texas up to Kansas. But I think this is more of a probability forecast rather than a strict deterministic forecast. So if we are going to have some dry spots, it's probably over the southern plains rather than anywhere else. We may see some spots show up here or there elsewhere as well, but I'll get to that in a second. And really what I want to talk about is why I think this will be a better summer than some other ones. And what we're looking at here, I mentioned analogs, so we're going back in time to show some of the different years that look similar to this year. And what we're looking at is our top two analogs, the ones that match most closely to what we're seeing right now. First one at the top is 2009, so remember that. And we're going back 14 years, but if you can remember back to 2009 and how those conditions went, Bryce Anderson actually had a good story on it last week about how that season went. But for the growing season there, the heart of it, June through August, it was actually pretty cool across a lot of the country outside of Texas and the Northwest. And precipitation-wise there, the top right, for the most part, everybody got near normal precipitation. There were some areas where precipitation was a little bit more than normal, and you can see a couple of spots there, kind of the mid-Mississippi Valley and off towards Wyoming, and a couple of spots where there were some misses, and thunderstorms that developed in the plains and moved eastward kind of missed a couple of spots. But overall, the precipitation was pretty close to normal. The second analog is actually 1951. And so I'm sure a lot of you don't remember 1951, but that one was also pretty similar to 2009. We had a very cool north central U.S. Corn Belt area, a little bit warmer there from Texas across the southeast, but again, the precipitation patterns were fairly normal, or even slightly above normal for areas like Kansas, Missouri, and up into Wisconsin. So overall, our top two analogs, the ones that match closest to what we're looking at now, kind of indicates to us that we should have some cooler conditions during the summer, not as much heat stress, and overall some better precipitation. We go to analogs 3 and 4, though, we get a little bit different. So number 3 is actually 2002, and that one doesn't quite match as well as the other ones, and it was one that was very warm during the summertime. So we had a lot of heat stress, and we had some areas of dryness there, especially in the western half of the plains, and some areas around the eastern Midwest as well. But overall, the precipitation didn't turn out too bad, not as bad as some of the other years, especially coming out of La Nina. And 2014 is our other one there at the bottom. And that one was, again, another cool summer for most of the country. But this one was abnormally wet. So this one was a very a wet year, and we had no issues really with drought except for a few spots here and there. So overall, if you look at these top 4 analogs, what we're seeing is a pretty good chance of cooler than normal temperatures and at least near normal precipitation for the bulk of the Corn Belt. So I think that bodes well for the growing season as a whole. Maybe not your farm specifically, but for the whole area as a whole. So then breaking that down again, getting into our temperatures. June does look like a warmer month out of the 3, especially if you're east of the Rockies. Once we get into July and August, though, we look at the Corn Belt, and for the most part, we don't have a whole lot of issues there with heat. If we do get some heat bursts through that, they'll probably be short. The exception might be up there in the northern plains and in the Canadian prairies, where we may have some issues for spring wheat. We'll see if that actually holds true or not. And in terms of precipitation, we're getting back into what I would call a normal pattern. So we've got precipitation starting off in the plains, those thunderstorm clusters building up and moving east across the Corn Belt and across the southeast. So I think a lot of those will develop more normally than we've seen the last few years. So over the last couple of years especially, they've been not developing in the plains, but rather in the Mississippi Valley and moving eastward. And so the eastern half of the Corn Belt has had better rainfall than the western half. This year, I think we've got a little bit better chance of seeing that being closer to normal there in the western half. Now, June might be one of those drier months for the south central U.S. Again, not good for the winter wheat situation, for anything that's still out there and still maturing out there. July is the biggest concern for me, and the dry signal we're getting is not necessarily from the analogs, but from the models. And the models are kind of showing July to be an abnormally dry month. Of course, that's not the time of year when we want it to be dry. We've got corn pollinating and soybean setting pods. We've got spring wheat heading, and getting dry conditions during that time frame is not a good time. But if we do have some late plantings this year, we push that back a little bit further in toward August. August actually looks like a pretty good month for most of the Corn Belt and the northern plains. So we should have really, as long as this forecast holds true, we should see some pretty decent conditions there for soybean fill and for corn fill, as long as we didn't have too much issues there in July. And for the most part, I think we're looking pretty good. Again, July is a little skeptical just because that's a model thing more than the analogs, but we have to blend the two together, and that's kind of the picture we're showing. So again, summer takeaways. We don't have any strong weather drivers. La Nina is not in the picture anymore. So all these subseasonal factors that are very hard to forecast are going to be driving weather. But that does usually mean that we're going to be more normal in terms of precipitation. At least the patterns will be, fairly active during the summer season. Temperatures, the models are a little warmer than the analogs suggest. So I tend to believe the analogs a little bit more than the models. So I think we have a better chance of at least having some cooler conditions during the summer to have less heat stress. More optimism again for a normal summertime precipitation pattern. But even so, we might have difficulty getting that drought out of the west without it really coming out in the spring and only normal precipitation during the summer. It's really going to be hard to eliminate the categories of drought there. So we may have issues still for forages and crops out that way. But, if we get normal precipitation patterns, the drought or the category of drought you're in might not matter. You can still have a good crop in drought as long as the precipitation is on time, even if it's a little bit below normal. So just kind of putting this into perspective, we're looking at here the corn yield from the USDA, and the gray line there is the trend line. And we're just looking at the last 30 years worth of data from the USDA. And I circled some of our analogs on here, the ones that are the most important. 2009 is our top analog, and that was a really good year for corn yield, soybeans as well. Our really hot analog, our 2002 one, there circled on the left, was a below normal year. But our really wet one was in another above normal year. So overall, I think we've got a good chance for most of the country to have beneficial weather patterns here through the summer. Looking at fall and harvest, I'll be really brief about this because we start to get beyond our 6-month time period for models, and whether or not we're in El Nino is going to matter. And so our confidence on the fall season is still pretty low. But overall, what we're seeing here is a lot of variability in terms of temperatures, not so much in precipitation, a little bit lighter overall. If you look at month by month, you can see again a lot of variability in these images. So going from September, being pretty warm across a lot of the country, cooler conditions in October and November, but a lot of this looks like variability to me. And when we look at precipitation, we see a lot of that as well. So, harvest, I think, might have some issues in some places if this continues to kind of showcase itself. But overall, if it's a little tough to get the crop in the ground this year, maybe a little late. We have good growing conditions during the summer. If we have some issues at fall, I don't think you'll mind too much as long as you get a good crop. So again, for fall, do we have an El Nino developing? Models are very confident about that, at least getting into a weak El Nino situation, but that's a long ways out, and we can't trust them too much beyond, say, August. So we'll have to see that. But if the analogs remain true to what we're going to be seeing, we're going to have a lot of variability there for the season. And again, if drought does linger in the summer, fall doesn't look like a very good period to eliminate it. We might have to wait until winter or spring coming up to really eliminate that. Now, the good news is if we are in an El Nino, we should see a better precipitation pattern across the plains and really kind of eat into any drought considerations we have there. Now, I just briefly want to go over South America as well, because South American weather and the crop situation down there is really important to our market situation that Todd's going to talk about coming up. So just briefly going over, Argentina's just had some absolutely terrible conditions. Everything that's gone wrong has gone wrong for Argentina this year. It's been super hot and dry for most of the season. Every time they get a cold front to come through, it's been very isolated. Precipitation's been way below normal. And if you're looking at the map here on the left, we're looking at soil moisture. And if the map on the right is trying to kind of orient you to where the main growing areas are there in Argentina. And if you look there, it doesn't really matter what part of Argentina you're in. It's pretty poor. And, it hasn't been just heat and drought, but even late last week, or it was a couple Saturdays ago, they had frost. And frost in mid-February for them is like Oklahoma getting a frost in mid-August. So it's absolutely ridiculous that happened. Everything's gone wrong for Argentina. In Brazil, it's been a little bit different. The southern portion of the state there circled in red has been a lot like Argentina, very hot and dry. Conditions have been pretty poor. In the middle part of the country, it's been a lot different. It's been a lot wetter. And you might be saying, John, there's a lot of red dots on this map. What are you talking about? But we have to remember that a lot of this data comes from satellites, and they're in the heart of their wet season where it's raining every day. So they've got clouds there all the time, and so it doesn't really pick up so well. We've been, talking about and hearing about how the harvest has been delayed because of wet conditions. The planting season has been delayed because of that as well. And so while the soybean crop is actually going to come out pretty big, and Todd's going to talk about that here coming up, we're concerned about the delayed planting for corn, their safrinha corn. And so just recapping what's been happening over the last few months, you can see that Argentina has been very hot on the left, very dry on the right, and central Brazil has been kind of the exact opposite, being very cool and wet. This is the same sort of pattern we've seen the last 2 seasons as well. And that's really led to some delayed planting, not just here in the middle of the country is the one that I wanted to show here. It looks like that got overlapped, but that's okay. They are still behind normal in their planting, but they've caught up even with all the rain going on. They're still behind by a few days, but it used to be a couple of weeks, so they're really making some good progress there. And then the state of Paraná, which is the second highest production state in Brazil, we haven't gotten new data from them yet since February 13th, and at that time, squared off in red, only 12% of the crop had been planted so far. And I've heard reports that we're only at about 30 or 35%. at the moment. So we still have a lot of crop that still needs to be planted, and not a lot of time left before the wet season ends, because during La Nina, even though it's going away, what we see is the wet season end abruptly in April most years. So if you look at this map, for the state of Mato Grosso in central Brazil, the red line down the middle is the average end date of the wet season, which is the first few days of May. But all those blue circles there are La Nina years. You can notice a lot more of them on the left side of the graph. And so a lot more, that indicates an earlier end to their wet season. So if they're planted late and they have an earlier end to their wet season, that doesn't bode well for crop production there for corn. So we're going to have to watch that specifically. Argentina, unfortunately for them, just does not seem to have a break. A lot of their early planted crop is already maturing, and their yields are set. Some of the later planted crops still have some time, but this forecast here that I'm showing here for their fall season, remember our spring is their fall, for March, April, May, very hot again and dry. So we're not seeing any real potential for a yield boost out of Argentina. A lot of their production estimates continue to fall. For central Brazil, and this is where we're kind of most concerned about it for those farmers there, and the tight supply situation that we're in, is that central Brazil also shows warmer conditions there, but drier signal as well. So the analogs are suggesting it, the models are suggesting it, that we're going to have an early end to the wet season yet again. So we're going to have to be concerned about, is that corn crop going to get through pollination before those rains shut down? Or are they going to be completely dependent on subsoil moisture? And if they are, that's not a good sign for them. So again, just taking all that away, La Nina is still going to impact Argentina. The hot, drier conditions aren't going away, and it looks like a bust for them for this year. We also see a shortened wet season in Brazil, and that's going to be very important for them, again, with the late plantings that we've had for corn. And so that's where our biggest concerns are for South American weather. So with North and South America taken care of, if there are questions that are coming through, I'd love to take them. Otherwise, you can email me directly, and I'll get back to you. Or I'm writing about this every week, and so just check out the blog space there on dtnpf.com.
All right, thank you, John. We've got a number of questions coming in. I want to mention, you mentioned Bryce's blog in the Ag Weather Forum space, sort of looking at that 2009 analog. That was my first summer working at DTN as an intern, and so I don't remember a lot about it because I was so busy trying to learn everything else.
Sure.
So the first question we have here is Canadian planting weather. What's it looking like for spring, and is there possibility of a May frost?
Absolutely potential for a May frost. There's still a lot of variability in that forecast for May, even all the way up into Canada. So yes, we could be having issues with that yet again. So we've had May frosts, I don't know, the last 2 seasons specifically, still controlled by La Nina. Now, even though we're getting away from that, and I mentioned how May is more kind of a normal month anyway. Normally we have May frosts in Canada, so depending on where you're at, the west not so much as the east, but still, we do have risks for frost in May, even possibly late May, so I would not be surprised to see that at all.
Okay, so when typically will we know about an El Nino situation? When will that develop? By August, by November? What's your feel?
So, the models are, I showed them to you, the CFS, our American model, is pretty adamant about getting it in the summertime. Some of those other ones across the globe, and the European model, the French one, and the German one are all kind of maybe later in the fall. So there's a 3-month window where it may be developing. We don't have a lot of confidence on when that might actually occur. For this season, it doesn't really matter because of the lag time that really impacts our crop situation or our atmosphere. We wouldn't really see the impacts of an El Nino, even if it were to start in July. We wouldn't really see the impacts of that until September, October, so harvest time. So, yeah.
Okay, if we do see that, what tends to be some of the patterns with El Nino kind of moving into the winter?
In the winter, east of the Rockies, we're usually warmer and wetter. So for a lot of the areas that have been looking at at the wintertime and just having absolutely terrible dry conditions, typically we see wetter conditions. So, eliminating some of that drought in the plains would be high on the list. The West Coast, though, unfortunately for them, they go drier. So, for the most part, not everybody. The Pacific Northwest, I believe, goes a little bit drier. Those in California, I think, stay wetter. So, overall, it's a better pattern for wintertime and early spring next year to get some of that momentum built up and getting some of the moisture back into the ground for 2024.
All right, if you have any questions for John, please drop them in the Q&A. We'd love to ask them for you now. And now I want to ask you, John, I know when farmers are getting ready to plant, they want to know if they're going to have wide open windows or if they're going to have to hustle in between rainstorms. What's your feel?
Yeah, I'm concerned more about the windows being short due to cold than due to wetness, especially for the eastern half of the Corn Belt. As you saw in that soil moisture graphic, we don't have a huge reserve of soil moisture out there right now, so we're going to need that to penetrate through. So if we do get rainstorms, they should soak in pretty well and pretty fast. But I don't think we're going to have a huge muddy mess unless we get a bunch of these snowstorms, and that's a little bit delayed. There's always a caveat with weather for springtime. But for the most part, I'm more concerned about the cold kind of limiting our windows more than the precipitation.
Okay, interesting. Now, Andy Jung earlier talked a little bit about river issues. What's your thought on the forecast and how that's going to play out for the Mississippi River this spring?
It's actually been quite remarkable. This active pattern has really built up a lot of moisture. At least eliminating the drought has been a good thing for the Mississippi River Basin. And we've seen those river levels increase quite significantly. We've been back in October, it was just abysmal and historically low river levels there. But once we kicked the active pattern going in November, it hasn't really quit. So there's some areas now that are forecast to be kind of close to flooding on the southern half of the river over the next week. So, with this forecast being active through March as well, I think we've got at least a good base here for keeping those river levels up through the spring season at least.
So maybe looking a little longer term, what's it going to take to really break this drought in the West?
It's going to take a lot of rain over a long period of time. They've been in drought for years. So, it just doesn't go away by one snowstorm or one big event or even several big events. As we saw back in January when California, who had been, if you're looking at the drought monitor, in that D4 toughest category of drought, they had record rains move through, all sorts of flooding, big snowpacks in the Sierras, still in drought. So even with this pattern over the last week or so of having heavy precipitation move back in, it's been another time period with, yes, we're helping, but we're not there yet. I know I got a question about the Colorado River recently too, and we've seen some better precipitation up through the southern half of the Rockies and in the Southwest. But again, it takes a lot of time for that to actually kick itself out. So it's going to take probably another year to really lose all of that impact from the last few years of drought.
Is that something El Nino might help with?
Absolutely, it will.
Okay.
It should. If we're confident in El Nino developing, it actually does, and it follows an El Nino pattern like we expect. Yes, we should get help this coming winter.
All right. Any other thoughts you want to share, John? We cover it all.
I think that covers it all.
Okay, wonderful. Well, thank you for joining us here in the studio. We're looking forward to having you again at our whenever our next conversation is. I know, are you going to Commodity Classic?
I will, yep. I'll be at Commodity Classic. I'll be talking Saturday morning, early in the morning, right after open at 8:15. So if you're there, I'll be kind of going over the same situation, just kind of an update on kind of what the spring holds for us.
All right. And if you don't see him there, you can always read John's work in the DTN Ag Weather Forum and on the homepages of dtnpf.com. Thanks, John. And we're going to take a quick break here. We're running a little bit ahead of schedule, so we're going to take about 10 minutes here before we bring in Todd Hultman, our lead analyst, to talk a bit about the grain markets and what this weather forecast John shared with us means for your marketing opportunities, what the potential impact on prices could be. So stick around. We'll be back in about 10 minutes. Welcome back to the DTN Ag Summit series. I'm Farm Business Editor Katie Dehlinger. I'm also very pleased to be your host for this event and for all of our Ag Summit series events. You know, we did our Ag Summit virtually in 2022 and we had a lot of great response to it. So we decided to bring these types of content delivery vehicles, this interactive, not quite a Zoom, not quite a television broadcast, to you more frequently. So we're going to be doing these events about every quarter. We're looking at May for the next one in August tied around our digital yield tour, and then our traditional Ag Summit, the full 2-day event in December. And so I want to just get that on all of your radars, because I know if you're tuning in today, it's probably something that you'll be interested in, and I look forward to seeing you there. And so we're going to move on into our next session today. We've got DTN lead analyst Todd Hultman with us. He's joining us from Indiana, where he lives, and happy to have you on, Todd.
Thank you, Katie. Thanks, everybody. Glad you tuned in once again.
Well, and Todd, I know we've got a really interesting topic today. We're going to be talking about grain markets for spring. It's something everyone has on their mind. We just heard John's weather forecast, and so I'm going to turn the floor over to you to go ahead and tell us about what you're seeing for the grain markets this spring.
Okay, thank you. Well, glad to have everybody back. Last time we did this was in December, and so as you probably know, when I talk about markets, I like to start with kind of some of the outside context. That next slide, and we'll see the list of market worries. And actually, the list right now doesn't look too different than it did last time we were together in December. Looking at this, we still have, I'd say, the chief market worry from outside markets is the threat of inflation. It hasn't really come down much. We're still a long ways away from that Fed target. There's going to be more rate hikes ahead. That seems fairly certain. And of course, there's always the question, is this going to cause a recession in the U.S. and hurt demand of a lot of things? So that remains on the table. We also still have the Russian threat, or the Russian menace, continuing to do a number on Ukraine, making life very difficult, especially in eastern Ukraine right now, where the fighting is intense. And obviously, it's very difficult to be a farmer these days in Ukraine. And we'll talk a little about what that has meant to markets. We still have a situation where fuel supplies are tight. There has been a build in crude oil supplies just the past month and a half. We'll talk about that. But the push to go green, it continues to make a very tight situation in our petroleum markets. I'm sorry I was busy with other duties this morning. I wish I could have heard Brian's talk on diesel, but I'll give a little bit of my own take on that. We have obviously expensive fertilizer prices, and unfortunately I missed that talk this morning too, so I'm going to have to go back and do some homework again. But we'll mention the fertilizer situation coming up here as we get closer to spring planting. And then, of course, right now, one of the threats and concerns we have are more record crops on the way from Brazil. And soybeans, the answer is yes, and that's being harvested right now. As you heard John talk about in the weather forecast for Brazil, we're not so sure yet on how that corn crop is going to look this year. But if they do get decent weather, they are going to have another record corn crop from Brazil. That continues to be a worry. Let's go to the next slide, Nick. First of all, I want to address this whole situation with the economy, and I'll try to do it briefly here. But, you know, there's been so many negative headlines in the news, and really over a year now, I think we've been hit with all the bad economic news. We've had 8 interest rate hikes, everybody predicting a much slower economy ahead, and yet it hasn't really happened yet. We've seen a little slowdown in economic activity. But I put together this chart just to give us an idea of what the economy is actually doing. So if we use the S&P 500 index, the companies in that as a proxy for how the economy is doing, we put it together, and this chart shows what they're actually returning on assets. So if they're right of the zero line, they're making money. If they're left of the zero line, they're losing money. And then the other graphic on here is a measure of how much debt they have. So we want to see what kind of exposure they have to these higher interest rates. Well, I can tell you that over the past 12 months, in this time frame that we've had 8 interest rate hikes, there are only 11 of the S&P 500 companies that are showing losses on the year, and really only 6 companies showing significant losses. And those 6 companies are cruise lines and casinos. So it's leftover wreckage from the pandemic. As far as the rest of the S&P 500 companies, they're actually doing fairly well, you'd have to say, considering the interest rate hikes we have. Now, a lot of the worry is not so much about what's happening now, but it's about what might happen. So the red line that you see on this chart is a simple little stress test. Right now the federal funds rate is at 4.75%. A lot of the experts and talking heads think that it will peak somewhere around 5.25%. Well, let's say it goes higher than that. Let's say it goes to 6%. And let's say these companies lose 2% of return on their assets. Now what does the scenario look like? Well, in that scenario, we have now 46 companies that are losing 1% or more instead of just the 11. Yet, other than 46, we have still a lot of companies making money. So to put this in perspective, all I'm trying to say is that the negative economic advertisement in the news has been much harsher than this whole situation deserves. And unfortunately, that gets reflected by traders who often give us sell-offs in the markets from time to time because they're worried about what may happen to the economy. But overall, this economy is at risk of, I would say, a moderate slowdown. But this is nothing like, say, 2008 or anything like that. This is not yet showing a drastic concern overall to the economy. And for that reason, I'm not overly concerned about the demand side of the market. On the next slide, please, shows the number of people employed in the U.S. And the number of U.S. jobs in January hit over 160 million. The good news is that's the most we've ever seen on record. We're back up above the pre-COVID peak for actually the second month now. And the good news is we've largely recovered from the worst workforce disruption since the Great Depression. If you want to know why box beef prices are high, I think it's because the economy is largely still doing very well, and we have this nice surge in jobs, which is good news. Now, some are concerned, is that going to cause inflation? People going to work does not really cause inflation. That's not the problem for that. One of the biggest causes, I think, in this situation has been our restricted oil production, and that remains a bit of a concern. Now we go to the next slide. Some of the good news that's been happening lately, we've seen the transportation costs of shipping grain come down dramatically, down roughly 39% from last May's peak. The cost of shipping grain by Panamax from the U.S. Gulf to northern China is represented by that blue line. We have the same situation for Brazil, represented by the brown line. Overall, the logistical issues and problems coming out of COVID are largely being resolved. We're not seeing the congested ports anymore, and that's all very good news for grain movement looking forward. Fertilizer prices. Well, they're not back where they used to be, but they are coming down. That's the good news. In the case of anhydrous, current prices are down roughly 27% from last spring's peak. Urea is down even a little bit more, down 35% from last spring. There's been a number of things, I think, contributing to this. One of them is the logistical issues that I just mentioned. It's getting easier to transport grain. I think it's good news that the water levels on the Mississippi River are looking to be in better shape when we get to spring. And another big factor here, the price of natural gas. Who would have thought natural gas prices this winter would fall below $3 per million cubic feet? It's been quite remarkable to see this drop in natural gas prices this far. And one of the really, I think, good hero stories coming out of the pandemic is how quickly our natural gas production has rebounded. We're now up to almost 123 billion cubic feet per day. That's a little over 5 billion cubic feet from where we were before COVID hit. So there's been a big rebound in natural gas production. It's not only helped us restore supplies here in the U.S., but as you know, it helped restore supplies in Europe last fall after Putin cut them off from natural gas, and they were in a very tight situation. The good news is natural gas prices have also come down in Europe. I can't say that they've restarted up their fertilizer production again. You know, they had to stop last summer because they were rationing natural gas, but it does look like they could start producing it again at some time when they get more comfortable, and probably when they get comfortable with having the cold weather behind them. Perhaps that activity will open up. So overall, fertilizer prices are headed the right direction. I know they're not coming down as fast as anybody likes, but the good news is I think we are going to have lower production costs for the 2023 crops. Crude oil supplies, we've seen a nice build in crude oil inventory just in the past month and a half, and this is something that normally happens seasonally this time of year. And in fact, last year we had a decent build from this time up until mid-March and got over 500 million barrels. But as you know, that was not enough for summer demand. What we did last year, which you can see on the blue line here, of 2022, and of course we're at the red line of about 479 million barrels. So the good news here is we're not yet back to pre-COVID levels of production, but there has been some increase in the past couple months. So we're still about 700,000 barrels a day below where we were before COVID hit. So for that reason, I'm still a little concerned that we're vulnerable to tight supplies, but it is nice to see some improvement here. Diesel prices, by the way, still at their second lowest supply level in 8 years. So diesel supplies remain tight. I'm going to need more of that soybean oil. All right, next, let's go ahead and move into the corn section now. And we'll go to our first chart. Corn parameters about to change. If you recall, last December, I talked about the stable period of corn prices we had from 2014 to 2020. It was a time of corn surplus, mostly good weather. Our production costs were a lot lower at that time, $680 an acre. And we had roughly an ending stocks level of 2 billion bushels of carry every season, give or take 1 or 200 million bushels. That got all disrupted shortly after COVID. We saw a big surge in China's purchases we didn't expect. We had some South American, Brazilian soybean shortfall on their soybean crop last year. All those things helped support soybean prices in a new higher range. And instead of a 2 billion bushel carry, we're now estimating, or I should say USDA is now estimating 1.27 billion bushels of carry in this current season. That's the second lowest in 9 years. Well, if you consider that, we've been trading this higher price range, the $5 to $8 range, largely on the back of tighter supplies and also higher production costs, kind of a twofold combination there. I think we have to say, moving forward into the new crop season, we have to consider that these parameters are going to drop. And I'll get more detail about my new crop expectations here. But overall, I think we're going to see a combination of both higher surplus in the new crop season, as well as some reduction in your production cost in 2023. And of course, when I'm talking about corn production costs, I'm talking about USDA's estimate, which is a national general figure. It doesn't always apply necessarily to your farm. And of course, if you're in a situation where you get much better than average yields for the country, you can do much better on that cost situation. But just so we're all on the same page. Nick, let's go to the next chart, where we see competition from Brazil increasing. It's not only in soybeans that we're getting more competition from Brazil, but we're also seeing it in corn production. The blue bars on this chart is the amount of corn that Brazil produced each year since 1981. You can see the current estimate is just under 5 billion bushels this year. If true, that will be another new record crop on top of last year's record crop. Now, a bit of bearish surprise this year has been that Brazil's record crop from last summer has been so good that it really kept the U.S. out of the export market until now. And just now, our corn prices are starting to become more competitive with Brazil. And we should have about a 3 or maybe 3.5 month window ahead of us here before Brazil's next corn harvest comes due in July. But as you heard John mention, there's a little question about just how well that crop is going to do. If they get the good weather, if things do look good enough, it does look like Brazil is going to pass us as being the number one exporter of corn this season. USDA currently has Brazil ahead of us by a slight amount, expecting 1.97 billion bushels of corn exports. So every year that goes by, they're expanding acres more and more all the time, and Brazil is becoming a tougher place for us to compete with. And by the way, I probably mentioned this in December, but back in the fall, USDA did a study of the potential of Brazil acres, and they expect 49 million new acres of cropland in the next 9 years. So a lot of potential in front of us from Brazil. We can go to the next slide now, take a look at the map of Ukraine. Just another reminder of how tough things are even today. Fighting is in eastern Ukraine is described as intense with a lot of casualties on both sides. Winter wheat is largely grown in eastern Ukraine area and has probably suffered the most. The corn crop in Ukraine is mostly in the north central region, a little farther away from the fighting. But things in 2023 are going to be even tougher as far as farm production in Ukraine than they were a year ago. And of course, they're running low on resources. They're low on fuel. They're low on fertilizer. It's becoming more difficult all the time to transport grain, especially to ports. It's become much more expensive. In the current season, it's quite impressive that Ukraine's corn exports are only estimated to be down 176 million bushels from a year ago. That's really not much of a drop-off. But in 2023, that will likely drop off even more. The early estimate of Ukraine's corn crop in 2023 is just a little over 700 million bushels versus a pre-war crop that exceeded 1 billion bushels. So life is just becoming tougher and tougher all the time as that war continues. We can go to the next slide, Nick. Ethanol demand is a big part of corn demand, and as everybody well knows, and here the blue line represents corn's processing value. So when the ethanol plant takes in corn and produces ethanol and distiller grains and corn oil, what they got this past week was a value of $8.40 per bushel. Now, last fall, that processing value was in the $9 to $9.50 range, and we had a healthier, more active scenario for corn demand from ethanol plants. But with that processing value down, the margin has dropped somewhat. So now the estimated difference between that processing value and the cash corn crop, as determined by our DTN National Corn Index, is $1.82 a part, where before it was $2 and above. So even though the ethanol demand has seemed to have tapered off here, though, it's somewhat impressive that ethanol production is still up 1% from a year ago. And I think a couple of the headwinds that we're up against here is, of course, in the Western Plains, the corn just isn't available. We see much higher prices for corn in the Western Plains, and it's tougher for ethanol plants to make that all work. We're also seeing lower gasoline demand this year. If we look back since September, which matches our corn crop season, the gasoline demand is about 5% from a year ago. And so you have to, give it its due that typically means slower ethanol demand when you have slower gasoline demand. Part of that could be slower economic activity. Part of that could also be due to the new influence of electric vehicles coming to market. So there's a host of factors there. But that slower gasoline demand, I think, has somewhat hurt those ethanol margins. The next slide, Nick, we'll take a look at the national corn basis. Here, you see a lot of colored squiggly lines. But basically, those lines represent the corn basis that we've seen over the past 20 plus years. And as you can see, I have circled there this year's basis. We're actually 8 cents above the March contract as of last night. The DTN corn index settling at 651 last night. That is just head and shoulders above where the basis normally is this time of year. Normally, we would expect something, say, 19 or 20 cents below the March contract. But the fact that we're staying 8 cents above continues to be a strong sign of corn demand, even though we've had a very difficult time on the export side this year. So domestically, there still seems to be a good market for corn. Now we can go to the next slide. Okay. Now, as you know, last week on Thursday, USDA released its new crop expectations. And as you all know, it's not based on anything substantive. These are just our best, or I should say USDA's best guess efforts of penciling in what the new year might look like. And in that same spirit of understanding that we don't, there's a lot we don't know yet about the new year ahead, I wanted to also take advantage of the input that we're getting from John Baranick today and the DTN weather team, who basically are forecasting a much more crop-friendly forecast for the summer ahead. And yes, there will still be problems probably in Nebraska and Kansas, and of course farther south to Texas as the season goes. But by and large, John was just describing to us it's basically widely normal temperatures, maybe even a little cooler than normal temperatures, depending on the analog. And for the most part, average rainfall for areas, which is something that we really did not obviously have last year. And also the lack of extreme heat scenario that we saw in a lot of places last year. So with that in mind, USDA is trying to give us a fairly neutral representation of what they expect is possible ahead. And they don't make a lot of assumptions about, if they expect good weather or not. There is a little weather factor in their yield estimate, I understand. But I wanted to show us what the possibility of a good weather scenario might look like for the new crop corn situation. And I'm not trying to scare anybody, but I think it's important to pencil out the numbers and just give us an early glimpse of what we might be up against if we do come up with good weather. So USDA is estimating 91 million acres of planted corn. I'm slightly lower at 90 million. We just haven't seen the corn and soybean acres available the past couple of years. Don't really expect much in the way of prevented plantings this year. That's probably a little favorable. But when it comes to yield, instead of 181.5, you can see I'm estimating 185 bushels an acre. Now that may sound like a lot compared, we just had 173.3 a year ago, but this 185 is only 3% above the 20-year trend. So yes, it could be high, but to me, for a good weather scenario, it seems like a reasonable estimate to consider. Our production estimates are not that far off. USDA is looking for 15.1 billion bushels. I'm looking for 15.2. But then here's where the differences come in. They're looking for ending stocks of basically 1.9 million bushels. I'm looking for ending stocks just under 2.2 billion bushels. I'm not quite as optimistic on demand as they are because of the competition we're getting from Brazil. Now, I cannot explain to you how USDA arrives at their price estimate, but I can show you, and I will show you, the model of how we get there. And our price estimate is based basically on three things. It's based on the historic prices of cash corn, what the production costs were in the years that those prices were made, and also based on the ending stocks to use ratios that USDA estimated at that time. And I can tell you, with a 15% ending stocks to use ratio, which is what the DTN scenario ends up with, the estimated price of corn is $4.50 a bushel. Now, obviously, we're trading above $6 on the current price, so there's an obvious potential there for some forward selling this year that needs to be done. And in fact, we started with our first 25% recommendation here on Monday. Nick, let's go ahead to the next slide now. This is the fundamental model that I developed for DTN, and this is basically showing the red circle is a 5% ending stocks to use ratio, which is the current situation that we're in, and that currently expects $6.31 a bushel. On Monday, we're at $6.52, I understand, but today I think we're $6.49 or so. So anyway, it's fairly close to what we would historically expect for this supply level that we're currently in at 5%. Now, if we move the needle to the right and look at the 15% ending stocks to use ratio, that's where we fall below cost of production somewhat. And that's where we come up with a $4.50 average new crop price. Now, even if we don't go that low on the price, the point is, I think that there is good reason for some new crop pricing early, which is why we started yesterday. The December corn price last night was $5.76. I believe we're down a few cents today, but there's still a considerable gap. And so we have to seriously consider about making some new crop sales. Not getting crazy, don't typically go over 50%, and it's going to depend, of course, on your confidence in production. If you're in a good growing area, you shouldn't have a problem. If you're in one of the drought states, you may want to take it easy on your forward commitments, of course. Let's go to the next slide, Nick. We'll see a red and blue chart here. The red prices are July corn, the old crop, as of last night. December corn, blue prices as of last night. Just a couple weeks ago, we recommended the final old crop sale of corn on February 15. And the point was we were well above in the upper $6 level range for the old crop price. And yes, there's a possibility that Brazil's crop might come up short this year, but that's a bit of a gamble at the moment. When you have this good and this profitable of a price offered to you, why don't we just take it? And so that kind of went into the thought process for that. Now, December corn, the blue price here, we looked at $5.76 last night. That's down a bit today. That's where we have the bearish concerns ahead. Now, keep in mind, not only do we expect a larger ending stocks level, so we're back up to the old kind of 2 billion bushel scenario that we saw in previous years, but also we're probably going to see some production costs come down. It's just going to be a totally different pricing scenario than what we've seen the past 2.5 years. I also took the liberty, if you see the 90% and 80% lines on here, I took the liberty of sketching out what the crop insurance coverage looks like it's going to look like this year. Today's the last of the February prices. It looks like the corn average for December is going to come in around $5.92. If you got a policy with 90% coverage, and we're going to assume that you maintain an average yield this year, then basically that 90% coverage protects you below $5.34 a bushel. So in comparison, 80% coverage protects you at roughly $4.75 a bushel. Keep in mind, again, that's assuming your yield stays even with your historic average. So those break-even numbers are going to vary because, as you know, it's revenue-based. Well, so I offer that out there to you to show that, number one, crop insurance looks like a good deal this year, no matter which way you go. Obviously, the 90% coverage has a better chance of getting hit, but then you have to weigh in, is it worth the extra cost to you? So hopefully, maybe this helps you a little bit make that decision. But going without crop insurance is not a good option in this case. So if there is good news here, it is that we do have some good pricing opportunities, even after the market's gotten hit the past several sessions here. These are still attractive levels in a good weather new crop scenario. Plenty of uncertainty ahead, but that's kind of my best advice for the moment. All right, Nick, let's venture into soybeans now. And we'll go ahead to that first chart. And again, we see the long-term chart for soybeans had the same situation. We had very stable prices back in the 2014 to 2020 period. At that time, ending stocks were roughly 500 million bushels. Usually, we had an interruption in there from the trade war with China. But for the most part, that stable period of $8 to $11 happened when ending stocks were roughly around 500 million bushels. Now we're looking at a 225 million bushel estimate in the current full crop season. That's the lowest in 7 years. So that's the main obvious reason why we're trading at these elevated levels. But again, like corn, as we look forward, we're probably going to expect higher ending stocks in the new crop season. And we're going to expect some reduction in the cost, mostly from fertilizer, but also possibly from the fuel cost. What's keeping demand tight right now? Well, up until the last few days here, we were challenging some very high prices. Looks like we found resistance about the $15.50 level on May corn, but we've had very active demand for soybeans, and I'll talk about that in a moment. That is just starting to turn loose. And while there continues to be a strong fundamental case to be made for the possibility of soybean supplies staying tight through summer, at the same time, I have to admit that technically we're starting to see the uptrend that developed as a post-harvest rally is starting to show signs of losing upward momentum. And of course, we're getting hit pretty good today. So I took the liberty this morning of making our fourth and final old crop sale of soybeans for the old crop side. And we started our first new crop sale on the new crop side. And I generally put those out as forward cash sales. But obviously, it comes down to your specific choice as to whether making forward sales works better for you, or is it better to get a November futures contract. So every farm different, every farm situation's different, and I have to leave those specifics up to you. Let's go to the next slide, Nick. Similar to what we saw in corn, we continue to see just rapid expansion in soybean production, the blue bars representing the amount of soybeans Brazil produces every year. This year, there seems to be pretty good consensus that they're going to produce something around 5.6 billion bushels. That's a new record high. We've actually had about 10 new record highs in going back to 2010. So they continue to just really excel in their soybean production and the expansion of that. By the way, this was the 17th consecutive year that Brazil's soybean plantings expanded. So just a remarkable trend that we're up against that shows no sign of slowing down yet. So obviously, if soybeans has one bearish factor in mind, it's this big crop that's currently being harvested. I think we're at the 33% mark as of this week. So that's definitely on its way. Going to the next slide, we see Brazil's soybean exports. We used to be roughly even with Brazil until about 2017, and then their expansion just kind of left us in the dust, so to speak. And this year they're expected to export almost 3.4 billion bushels of soybeans. And the big question is, how long will they dominate the export trade? So a couple of years ago, we were surprised that their exports basically ran out in the month of July. And then all of a sudden, and this is in 2020, by the way, their exports ran out in July. And then we had a big, long soybean export window, which really served us well that year and into early 2021. Well, this year we're looking at kind of the opposite situation. It could be possible with this big new crop that their export dominance will last well into September, maybe even October. But the farther they go, obviously, the more it narrows the window of opportunity for us to sell soybeans to Brazil or to China before Brazil's next harvest comes, typically in the February timeframe. So it's the big crop that we're seeing come from Brazil now really is more bearish for new crop prices than it is for our old crop situation. This has been a good year to ignore headlines. We can go to the next slide, Nick. And here we see how dependent China is on the world. And by the world, I mean largely Brazil, but also the U.S. For their soybean needs. In this case, we see China's soybean production going back to 1981, and it's basically been the same. I mean, it showed slight growth over the past several decades, but not much. And it's certainly, they are certainly nowhere close to producing enough soybeans to meet their needs. The red line is the amount of demand that China generates for soybeans every year. And in spite of all the bearish news we heard all last summer and all last fall and into this year about how bad China's economy was doing, they were getting hit with COVID, things were slowing down, their GDP fell. In spite of all of that, their soybean demand remains strong. And thankfully, because we can look at China's soybean prices, we could see that all through summer, and it helped us to ignore those headlines and recognize that China was still a very strong buyer and in need of soybeans. In fact, our export season this year, in the old crop season, has been so strong, China's soybean purchases were up 14% from a year ago. It's just been remarkable. And right now, to date, we only need, in the U.S., 143 million bushels of soybean sales to reach USDA's export estimate by the end of August. So even with this big crop coming on, we should have no problem generating that small sales amount over the next 6+ months by the time we get to the end of August. So that 225 million bushel ending stocks estimate USDA has right now, I would say is very solid. And in fact, there's a possibility it could go even a little bit lower by the time we get to the end of August. Now we can go to the next slide. The soybean basis is not quite as strong as what we've seen in corn. It started out that way through the fall and in January, but since the 1st of February, we've really seen the soybean basis start to slip more. And right now it's 42 cents under the March contract, going off of last night's DTN National Soybean Index. That puts us pretty much in the middle of the pack when we compare to what basis has done the past 20 years. So we started out strong, but that basis is normalizing. And I have to think that the anticipation of Brazil's big harvest perhaps is starting to bring that basis down for soybeans in the U.S. As far as, next slide, please, sorry. As far as the crush incentives are, I talked about this in December. We've actually been talking about this for a long time, and just about every daily commentary we continue to point out that the crush premiums, the incentive for soybean processors to keep buying soybeans and crushing soybeans, continues to remain very high. We have extremely strong demand for both soybean meal and soybean oil. And even though we're increasing the number of plants for producing renewable diesel, we are not seeing any signs yet of those margins narrowing. So we continue to have a very bullish demand situation as far as the crush totals go. This chart shows, the blue line shows the value of what you get when you crush a bushel of soybeans. You get $18.38 worth of bean oil and meal. And by the way, these are based on the May futures prices. Subtract from that number the cost of the May soybean, and you end up with a premium of $3.19 a bushel. Historically speaking, that's basically twice what it used to be before 2022, before they started using soybean oil to build this to convert into this new product, renewable diesel. And let's go to the next slide while we're at it. This is from the Energy Department. This chart shows the monthly amount of soybean oil used to make biofuels. And as you can see, this chart just continues to work higher the past 2 years. In the most recent 12 months, demand for soybean oil was up 21% from the previous year. And I'm referring to the amount of soybean oil used for biofuels. So that's increasing rapidly. We also know from the Energy Department that plant capacity for producing renewable diesel was up 141% in November from a year ago. And by the way, November is the latest statistic. We'll get a new update later today, and that'll be interesting to see. The Department of Energy also said that they expect renewable diesel production to increase by 52% this year and by 42% in 2024. So there continues to be a strong push of investment into this area. And it's a brand new market for soybean oil. It's a brand new market for soybean demand in general. And it's been a very strong component, and it continues to be a growing component for our soybean demand. Now, you may ask, okay, with all of this going on and all this looking so bullish, why did you recommend selling old crop soybeans today for the final 25%? And why did you recommend putting on a new crop sale to start the year? Well, as good as the demand looks, we also pay attention to the technicals, and I have to respect that we've had a pretty good uptrend in place. But there's been a lot of concerns lately that as it got to 15.5, it just was not showing the ability to push through resistance. And oftentimes, technically speaking, when you have a very profitable pricing opportunity and you start to see signs of that momentum dying, it's a good place to let go and take advantage of those higher prices. And so that's what we did. Nick, let's go to the next slide here. The early new crop soybean assumptions. So again, just like we did for corn, I did a little comparison here for soybeans. And again, I'm assuming a good weather scenario in 2023, relying on our DTN weather team, who served us very well last year. I should point out, last year they were on it very quickly back in December, that we were going to have a hot, dry season, and it could be a tough year for corn and soybean production. And in fact, that's what we did have. But as you heard, that's not what we're looking at in the forecast this year. So I'm taking the liberties of adding a little weather factor here. The plantings, I don't expect much different from USDA, 88 million acres. They're saying 87.5, no big argument there. My yield is bumped up to 54 bushels an acre versus USDA had 52. Production comes in a little higher for DTN at 4.7 billion bushels instead of 4.5 billion bushels for USDA. And then here's where the separation starts to show up again. DTN estimate comes up with 400 million bushels of ending stocks. That's a 9% ending stocks to use ratio versus 290 for USDA. Now, the price difference this may look odd to you that their estimated price is $12.90 a bushel. Ours comes out to $12.70 a bushel, even though we have a higher ending stocks estimate. Again, I can't explain the formula, or as I've tried to talk to USDA about this in the past, it seems that they make a judgment call when it comes to the price estimate. I don't know that they have an actual model based on history. So our history-based model says $12.70 a bushel. And the good news is $12.70 is likely going to be above the national average production cost this year. Last year's average was basically $11.90 a bushel, but this year we should get some improvement in the fertilizer and possibly in the fuel price. And so that $12.70 a bushel still should be on the profitable side of the ledger. Let's go to the next slide, please. There's where we look at our model. The red circle is the old crop ending stocks to use ratio of 5%, suggests a $15.36 cash soybean price versus we had a national average of $14.80 on Monday. Obviously, the model suggests a higher price than what the market's trading right now, but I think there's no doubt that Brazil's harvest is weighing on the market's mood right now. Then if we have better weather, the black circle goes to a 9% ending stocks to use ratio. That estimate, as I just mentioned in the previous slide, $12.70 a bushel. Our November price today is on the slide. Last night was $13.72, but we're down roughly 20 cents today, so about $13.52. There's still reason, a big enough gap here to make a new crop sale at this time. And so we started with 25%. And I probably won't be in a rush to bring it up to 50 unless maybe we get a better pricing opportunity. We'll just have to see how the time goes. Typically, our new crop sales in soybeans, typically you can have up until late June before prices really start getting pressured by a new crop outlook. But it seems to me that there's with Brazil's big harvest, plus I think a big general sense that we're going to have better weather conditions this year. It seems to me that USDA's ag outlook kind of kicked off some of those expectations and maybe solidified in our minds the expectation that we're going to have better weather. So I think the time frame for making these new crop sales has been shortened for us, is what I'm trying to say. Let's go to the last slide, Nick. Early estimates for 2023. We have our July soybeans. Now, that doesn't show today's sell-off of activity, but July's taking quite a hit today. And as you can see, we were in the July soybeans, we got up near the old highs. Prices were stalling out, and now today's sell-off does not look good from a momentum perspective. So that's where you can, I have a concern that, maybe it's just time to take advantage of these really good, profitable prices and call it good for the year. On the new crop side, the blue prices, the November, $13.72 last night. It's probably around $13.52 today. Still better than the $12.70 we're expecting. But notice the crop insurance prices here, which look really pretty good. The soybean average for February is going to come out to $13.77 today, give or take a penny. And if you got 90% coverage, that puts you at $12.40. 80% coverage puts you at $11.02. So it's interesting to me that at least if you look at USDA's price estimate or this good weather scenario I have from DTN, we're not down at risk of the $11 price level here. So just another factor to take into consideration when you ask yourself, is the premium worth it for that extra 10% of coverage or not? So just hope that maybe helps you see how it pencils out for your farm. I think that's the most of it. Nick, you can go to our concluding slide, and I'm open for questions and love to hear from you.
Great. Thanks, Todd. I've got a lot of good questions for you coming in through the chat. Let's go ahead and start with one from Kent. He says, USDA being so far off in acres in corn last year, coming out with 93 million in February and then going to an actual of about 88 million acres in the year. How much stock do you put in last week's report from USDA, and how do you think that's going to shake out?
Well, I don't. And I tried to explain that at the top, Ken. I mean, these are just ballpark estimates done on a napkin with pencil. There's nothing, there's no substance here. There's no evidence of what the corn acres are going to be yet. It's just our best guesses. And part of what goes into the best guesses, we still have some pretty good pricing opportunities available. It looks like we're going to have some decent crop insurance protection levels. So I think there's still good incentive to plant as much corn and soybeans as you possibly can. But, we've had that incentive the past 2 years. And even with that great price incentive, it's hard to get above 180 million acres on both corn and beans. I'll extend the question another notch and say, what do you think of the March planting intentions? And I still don't put much estimate in that either. So makes it a little tough because obviously what does get planted matters a lot. But a lot of it really depends on the weather conditions at planting time. And that's what's going to have a big say in all of this.
And one thing we hear a lot about this time of year, Todd, is that quote-unquote battle for acres that sometimes seems like it's more of a story than it is. I know you're looking at these soybean prices that are looking pretty strong and corn that looks like it could have some weakness. Do you see that playing into it, or any choices being made kind of around that element?
Yeah, Katie, I've done this for a long time, and in older days, or I should say younger days, I tried to put a lot of effort into figuring out which crop looked more profitable and then making that prediction. I have never seen any fruit come of that was worth making the calculations. For the most part, people stick to a 50-50 crop rotation unless there's something unusual going on. So, for instance, the year we had the trade tariff battle with China, there was a big drop in the soybean acres. But for the most part, it tends to be about a 51-49 split, and corn continues to be the favorite. And I think one of the biggest reasons is because we have so much corn demand here at home, and most people have it right in their immediate areas, whether they are affiliated with an ethanol plant or maybe have a couple ethanol plants near them, or they have livestock themselves or neighbors that have livestock. So corn still is a very strong market with domestic demand, and I think for that reason, it continues to be the favorite among acres. Profitable-wise, if I'm looking at new crop prices, honestly, the new crop scenario, in my mind, looks much better for soybeans than it does corn. We're projecting above cost prices for soybeans, and a lot of that is based on the very strong demand that we're seeing for soybeans. Now, that strong export demand is going to get hit most likely by this big Brazilian crop, but overall, the soybean demand continues to be very impressive.
Okay, so I know you mentioned a couple of times that sales recommendations, and I wanted to clarify that you're talking about the DTN 6-factor strategy recommendations, correct?
Yes, and so in our position, we're not a brokerage firm. I have no skin in the game. It's part of my contract. I'm not allowed to trade in the futures markets or any commodity markets at all. So we're trying to give you the most unbiased view of what we think crop prices will be, and we're trying to help you figure out a good time to sell your crops, both old crop and new crop. In that vein, no guarantees, obviously. We don't have any inside information that can guarantee anything. And obviously, we're making it for a general audience. So, you have to take that. If your farm is in Kansas or Illinois or North Dakota or whatever, you have to take that general information that we're trying to help with timing a bit in the big picture and decide what's right for your farm and how to execute that.
And we did ask a poll question about this in our app. We've got a few answers to it. It's still open if you want to take it in the audience. But just to share with you, Todd, we asked how many, or if you'd sold any of your new crop corn production. And we had a couple people that said no. We had about 3 people that said they'd priced between 11 and 25%. And then 2 people that said that they've forward sold up to 50 to 75% of this year's production.
Wow. Well, congratulations on that. Obviously, the sooner, if you did it before last week's break from the Ag Outlook Summit, it certainly was helpful. But that's interesting, and obviously, typically, as I mentioned before, we have a bigger time window to make these new crop sales. But just the way everybody's thinking this year, and I think there's a broad consensus that we are going to have better weather in the season ahead, I think it's tightened the window of opportunity we have to still make some very good new crop sales.
All right, I've got a couple other questions in the hopper for you, Todd. A couple of different veins. We're going to go to Brazil and then we're going to go to Europe. So let's start with Brazil. Who are some of the major buyers of corn, of Brazilian corn, and is it taking away market share from the United States?
Yes, it's basically crowding us out. I honestly have not seen the top list, but it wouldn't surprise me if it's a lot of Asian buyers.
Yep, Japan is among the top.
We still, so far, knock on wood, we've still had some decent business from Mexico, but of course, that's a whole other issue with the threat of a genetic engineered ban on corn from Mexico. But the main problem is that, most countries buy according to price. And so when Brazil had a record harvest last fall, it allowed their corn price to undercut the U.S. price several months, really all through the fall, and only until just the past week or so have we seen U.S. prices get more competitive. So they really crowded us out from everybody for the most part, except our closest neighbors.
Yeah, and just a little bit of research I can share from writing about this topic and talking to Todd about it is that Brazil is really exporting. Their largest markets are Japan, Iran, Spain, those markets. China, they just reached a deal on phytosanitary conditions about a year ago. The first shipment went out in November, but it was enough to boost Brazil to a record corn export last year. And a lot of analysts think that China could buy 6 to 10 million metric tons of Chinese corn this year. So there's some potential for things to change up in there. And as far as China, they would be taking some of that market share from us.
Yes, and a chart that I did not show today but have shown before is we see a growing gap in China between their ability to produce corn and the demand needs that they have. And so I expect China to be a larger and larger customer in the years ahead. And there's no doubt that those getting the conditions nailed down with Brazil to open up that trade was important to do, because I'm sure China expects to be a long-term buyer of corn from now on.
What an interesting shift, given the past decade and their emphasis on self-sustainability there. So pivoting now a little bit to Ukraine, you showed the map there. What would an extended war, another 1, 2, or more years, do to Black Sea grain, maybe in the 2024, 2025 timeframe down the road?
Katie, I'm sorry I missed that. I don't know if you can get closer to your mic, but it seems like you fade out on me a little bit.
Sorry, I am losing my voice, so that is probably me.
Sorry.
Ukraine production. what would the impacts of an extended war be into 2024, 2025?
Just a miserable thought. I mean, at some point, their ag production would go to zero. I mean, it seems to really be on a thin tightrope right now. Just the second year into it, I don't know how they're making money, to be honest, because with the fuel difficult to get, fertilizer difficult to get, and they have to be more expensive to get. And then it costs about 3 times more to move their grain to port than it did before the war. Those things are just not getting any better. And of course, Russia continues to attack the power infrastructure in the country. So the ability to do things like dry corn or store it is just becoming more and more difficult all the time. I honestly don't see how they continue to do commercial ag in a meaningful way each year that goes on. And I heard a lot of the U.S. aid that has gone to Ukraine this year has been for planting potatoes, because obviously they're in a situation where survival is getting more important than having a cash crop. So I think we'll just see further declines in corn and wheat, assuming this thing just keeps hanging on. But that's a big question mark. It's very difficult to know how this whole thing's going to end.
Well, that is our last question in the queue, Todd. Thank you so much for joining us. I know that all of our readers can catch your columns every Friday, your daily commentary throughout the DTN platforms. And if you are interested in getting access to the DTN 6-factor strategies, make sure to check out mydtn.com to sign up for a subscription. All right. Thank you very much, Todd.
Thanks, everybody.
All right, and now I am joined in the studio by DTN Editor-in-Chief Greg Horstmeier. He's here to help us take a look at the sort of reflect on the show that we've had today, the conversations around acreage and grain marketing and everything that's going with it. Welcome to the studio, Greg.
Thank you, Katie.
Well, I thought I was the one losing my voice.
Yeah, got a catch there. No, I appreciate it. Good to be back here. Great sessions this morning, and listening to Todd there at the end talk about some of the uncertainties in the marketplace. If I had to pick a word that I heard repeatedly through these sessions, it was transition. We started hearing about Brian Milne talking about the transition, especially on the soybean side, from petroleum diesel to soybean diesel, and how that was going to change some things in the market. We heard John Baranick talk quite a bit about transitions as far as the loss of the La Nina patterns and what that was going to mean. So a lot of those things coming through, and especially what Todd was just talking about here. So yeah, transition was kind of the word that I heard, and transition brings uncertainty. Mm-hmm.
But it also brings sort of an orderly element to it. When I think of transition, it's like there's a phasing in, you know what direction it's heading, sort of.
Yep. In some situations, exactly. And I think it also means that we sometimes have to take good with bad. I was thinking about Brian's conversation around the move to soy diesel away from petroleum, and the fact that there's not a 1-for-1, barrel-for-barrel when these plants either switch over or companies invest in producing soy diesel versus crude oil diesel. It's at a little bit of a lower production situation than what they would have been just doing what they've always done, which is turning crude oil into diesel fuel. So that means a little short-term, higher price at the pump, as Brian talked about, and we need to find those buying opportunities like he talked about here in the next coming weeks and maybe months to make sure we lock in the supplies that we need. Long term, though, if I switch to what Todd was just talking about in terms of Brazil becoming such a major competitor of ours, not only in corn but also in soybeans, have been for a while. Developing those domestic uses for soybeans is going to be an important thing. So I drive a diesel pickup. I'm paying a lot more than I've ever had before, but I think long term, moving into the soy market is going to be good.
I think one of the things Brian mentioned too is that this is a window right now with diesel prices being fairly reasonable, that if you are looking, and if you need a large quantity of fuel, it might be a good time time to talk with your supplier to do some of those things and make those choices.
Absolutely, buying opportunities there. Thinking of Andy Jung and his conversations around the fertilizer situation. I mean, there we're getting a little bit back to normal, so the transition there is a little bit back to more normal situation. John talked about the river coming up, so we should be in a better situation this year in terms of moving fertilizers throughout the year. We are, as Brian talked about, solving some of the trucking issues that we dealt with in 2021 and 2022, and so good things there coming in those markets. But again, as you said, buying opportunities, and in the grain side, selling opportunities. As Todd just talked about, thinking about that, we just in our 6 factors recommended some early sales, and your data is showing that some farmers are already beginning to do that. So it's a time to pay attention. We often talk about that here. We're in the information business, and we talk about the need to pay attention. This spring's going to be another one.
Well, I think a lot of producers are going into this year and thinking it's going to be a very expensive crop to plant, and I think everyone is very aware of that, and they're very aware that prices could go south quickly, and it could really change as far as the farm income dynamics. And so it's really paying attention to marketing is something that'll be more important. People tend to forget their marketing plans when corn's $7, when corn's up high, but it's something they really need to watch because if they can do well this year, it sets them up down the road.
Absolutely. And if we move into that La Nina situation, or El Nino rather, situation into 2024 and maybe 2025, where weather patterns are better, we know what that means. That means more corn and more soybeans, and that can mean lower prices if demand doesn't keep up. So you're exactly right. Making those pricing decisions now and making the margins you can while you can make them is going to be incredibly important in 2022.
And at the bare minimum, knowing your break-even costs and knowing how every sale affects that, keep a running total to make sure that you're really on top of the marketing and making sure you've got your plan for this year. And if the weather forecasts come in like it is, if we get the crop planted, lots of ifs.
Right.
But lots of things going.
Yep. And the need to pay attention to weather too. John was talking about the issues of some of the cold snaps and maybe tightening those planting and spraying windows up. So it's going to be a year to be on your toes and have everything ready to go when it's time to go.
Well, and I know that, this is just our event for this spring. I know that our John and Todd have been out on the road going to different trade shows and different events. Where are you guys all headed next?
Yeah, good transition, because I want to remind everybody, John mentioned it, but we'll be at the Commodity Classic in Orlando next week. And so please, the booth is there. Come by, visit with us, talk to us about some of the products that we've got going on there, and several of us will be in the booth from time to time. Love to talk to you. We love those events from the standpoint of being able to really just rub elbows and hear what's on farmers' minds. And so please, if you see us, stop us and chat with us. We'll have a pretty good team there. John's presentation, so a more broader weather presentation, is Saturday the 11th at 8:30, and so bright and early, grab your coffee and come into the convention center, and John will be going there. After that, we're a little bit quiet until we get ready for the summer shows, and so we're gearing up for those as well.
And I also wanted to mention, in that sort of transition from spring to summer and the summer shows, we're going to be doing more of our Ag Summit Series events, just like this one. We're planning one for May. I believe we decided, was it May 24th or 23rd?
Yep.
In there. We'll be
more
looking
on that to come.
More on that to come, likely to have a little bit of focus on crops as they grow and develop. We're also going to have one in August around our DTN Digital Yield Tour, which is something we're doing now for the 6th year, Greg?
6th year, exactly. It's been a fantastic program, and was talking with a group of farmers about that last week, and it's just grown in both its effect on the market and the number of people that are paying attention to it.
Yeah, and we partner with Grow Intelligence with that, and they have these really sophisticated yield models that we get to use and look at for corn and soybeans throughout that week. It looks really good. I'm hoping to have some folks from them with us for that Ag Summit Series event to talk about the models and what they show and sort of how it works. So that might be a opportunity for everyone to be involved in that. And then on December 5th and 6th, we will have our full DTN Ag Summit. It's our 2-day event. We'll probably do 2 mornings just to get it, give you guys plenty of time to actually get your work done in the days, and talk a little bit more about some of the business topics, get into some of the tax implications of the year, maybe talk a little bit more about Farm Bill since we are in that season, and some of those topics. So we really hope you guys will tune in for those. Keep your eyes on your email. We will be sending you details on those as we get more of those figured out and ready to go.
Absolutely. I want to remind everybody that these sessions are recorded, and when you're registered, you can go in and re-listen to them or pass them around to other family members or business members to listen to if they weren't available today. We hope you take advantage of that. That's one of the beauties of this medium and this platform. And so we look forward to you doing that. We look forward to talking to you again soon, and hope you have a safe planting spring.
Yep. But before we go, we really have to thank everyone who's been involved in making this production come together. You heard Todd mention Nick. We've got Nick Scalise and Nick Smith, both of them on the other side of the cameras here, talking and well, not talking, but running all the computers, making sure our audio works and doing all the technical work. We really couldn't put this program on without them. We need to thank Rick Thornton, our director of content, for all of his work administering the Hoover app and running that sides of that. I need to thank Greg Horstmeier here and our editor-in-chief of the magazine, Progressive Farmer, Greg Hillier, for helping put together the content and sort of guide that team. It really is a team effort to put these on, and it's something I've really enjoyed doing as we do this.
I think they're really coming together well. So.
Yeah, I'm excited. And so with that, we're going to say thank you very much for joining us. We hope you go out and you have a safe and prosperous spring. Thank you very much, and we'll see you at the next DTN Ag Summit Series.